Welcome to another great White Coat Investor webinar. I am here with Nathan Clayberg, Vice President at MLG Capital, and we're going to be talking about the MLG Capital real estate investing funds. These are private equity funds for accredited investors that allow you to partake in the real estate investment market, essentially as an owner, to be able to enjoy both the appreciation and the tax protected income from these investments, as well as enjoy the tax benefits such as depreciation being passed through to you. Nathan, it's great to spend time with you again. I think I last saw you at our conference a few months ago, but it's great to be with you virtually this time. How are you doing today?
I'm doing great. Appreciate you making the time to have me on. It's always great to connect with you and the rest of the White Coat Investor crew. Excited to share a little bit and got a lot of fun stuff going on at MLG. So it's kind of a unique time to be buying real estate, and excited to talk more about that.
Yeah, right now MLG is raising for their Fund VI. If you want to get more information about that, the best link is whitecoatinvestor.com/MLG. I've been invested in their Fund IV now for several years, and so that's been a good experience for me. But you cannot invest in Fund IV anymore. If you want to invest with MLG, you have to invest in Fund VI, and so we'll be talking about that as well during this webinar. But why don't we start with your prepared presentation? I'll let you share your screen and we'll run through a few of those slides and let those who don't know MLG Capital as well as you and I do learn a little bit more about the company and its funds and about the markets that it invests in and in its type of investments.
Absolutely. Yeah, I'll jump in here. And in my presentation that I'm going to share is a little bit more education focused. Obviously, there's been a lot going on in the broader market recently. And so I'm going to address some of the questions I'm frequently getting from investors. And obviously, we'll mix in the conversation about specifically how MLG is addressing those things as we go here. So we're going to just talk about a little bit about the general state of the union and commercial real estate. And I'm going to really focus my commentary around multifamily in our funds. That tends to make up the bulk of what we do. Typically, 80+% of our funds are in multifamily, and specifically hit on some of the rising interest rates that we're seeing, or this, I guess, prolonged period now of higher interest rates, and how that's affecting the market in our view. So just a quick agenda. We'll hit on what's going on in commercial real estate. We'll talk about the rise in rates, rent growth we're seeing in our portfolio, some of the supply and demand forces at play, why we believe in real estate in all cycles, and how to do it best in a risk-adjusted way. And then we'll talk about real estate versus treasuries. That's been a question I've been getting a lot recently. So we had some fun math that we'll run through and then provide for some questions at the end. Just what's going on in the broader commercial real estate world. We have seen significant rise in interest rates. The 10-year Treasury on January 1st, 2022 was opened at 149. As of today, last I looked, it was at 363. So it's a huge increase in rates. It ran as high as 421 during that time period. And rarely do rates move so much, especially so fast. The initial jump in rates all happened in the span of about 6 to 8 weeks and really threw a wrench in a lot of people's financing. So we're going to talk about the rise or the impact of higher interest rates on real estate, both from cash flow and evaluations perspective, and then talk a little bit about how MLG is addressing that. We're also seeing the end of the post-COVID era rent boom. After people were cooped up in their houses or apartments for several months when COVID was really prevalent, there was just a massive boom in rent growth. It was unsustainable. And finally, that is coming to an end. We knew it would. No one expected that 10, 15, 20% rent growth would continue. But now we're starting to see that end. Rent relief programs related to COVID are starting to end, which is creating some challenges in workforce housing. Part of the initial increase was a result of vacancies down to historic lows, partially as a function of the supply and demand equation we're going to hit on later. And you're starting to see some headlines. The pace of growth has slowed, and there's actually been some rental decline in select markets. There's a lot of negative headlines that people see that sound kind of scary, that rents are going down, the world's kind of ending as it relates to multifamily real estate. We don't think that's true. We're not seeing that in our portfolio, but it's worth talking about. It's worth exploring where the rents are going down and how you can actually counteract that within a portfolio. And then the last thing we'll hit on is just the fundamentals of supply and demand. This is our punchline of why we continue to believe in the thesis of private real estate, and most specifically multifamily and industrial. Those are our two preferred asset classes. You can see the basic stat occupancies are high. The supply and demand equation is still intact. So that's what we're going to kind of focus on, is those three broad concepts throughout this presentation. The first, we're going to just talk about rise in interest rates. What are the impacts of rising interest rates on real estate investments? Well, there are really two different areas that interest rates impact real estate. First is in cash flow. The second is in asset valuations. And the reasoning for the impact is a little bit different in both. So it's worth understanding what the actual impact is on both of them. And the first one we'll talk about is cash flows. Generally speaking, higher interest rates are a sign of inflation in the marketplace. We have certainly seen that. We've experienced that over the course of the past couple of years. The multifamily world experienced that in a big way with outsized rent growth. A lot of times, a growing economy, inflation, higher interest rates result in higher revenues. And we see all these different revenue enhancers across our portfolio. We certainly saw crazy rent growth. We saw increased occupancy, less concessions and delinquency, and the opportunity to create value in our portfolio. The question becomes, how do you navigate that as we exit that time and move forward into the whatever comes next in the market? But then you also see the impact of interest rates on asset valuations. Certainly, cap rates are what drives a lot of valuations in the real estate world. It's a multiple on the operating income that properties are able to produce. But it's not the only factor in the valuation equation. And a lot of people tend to think it's a little bit doomsday for cap rates when interest rates go up. We talked about, went from 149 to 363. That's over a 200 basis point increase in the 10-year Treasury, which is a commonly used index in commercial real estate financing. But there are actually a lot of other aspects to valuations that aren't directly correlated to interest rates, including the ability to grow revenue, like we just talked about, rent growth and ability to grow the operating income of an asset certainly impacts value, availability of debt, the terms of that debt, and the availability of equity in the marketplace. So broad strokes, we're seeing the impact of higher interest rates on our cash flow. At MLG, we're using primarily long-term fixed rate debt. And any debt we do have that is floating is financed or is secured with an interest rate cap in place to mitigate how high our interest rate can go. On the flip side, we're seeing higher cap rate opportunities right now, but it's not percentage point for percentage point with the rise in interest rates. Interest rates are up, maybe 200 basis points. Cap rates are up maybe 75 to 100, depending on the market that we're in. So we think there is actually a really unique opportunity right now to be buying in a slightly higher cap rate environment when we still believe that we have the opportunity to grow the revenue, and there still is the availability of debt at attractive terms relatively in the market. A big thesis around what we're doing kind of hinges on the ability to continue to see rent growth. You can see in the graph I have up here, at the end of 2022 or 2021, vacancies dropped to historic lows, and the result was pretty significant rent growth across the country. Obviously, we knew this wasn't sustainable, and you can see the beginning of it start to tick down. What we're seeing, though, is the pace of growth is absolutely slowing, but the growth is still happening. And for those that were underwriting in a disciplined way, there's still a lot of opportunity for those that are actually able to execute. You can't just rely on cap rate compression anymore, is what we're seeing in the market. Here's an example of what we are seeing in our portfolio. If you have the right business plan in the right location, there is still the ability to grow rents. This represents the average effective rent in our funds 4 through 6, which are the ones that are still mostly in kind of the renovation and value add part of the life cycle. From Q4 to Q1 of 2023, we saw 2% to 2.84% quarter over quarter growth, which annualized obviously is still very attractive. We're not underwriting that annualized growth number will continue, but that's a pretty substantial unit count that we're still seeing very positive growth overall. And we're executing on our business plans across the portfolio and seeing those still be effective. Lastly, we'll hit on supply and demand here. This is the fundamental punchline of real estate valuations and really most things, right? You saw just the same thing be true in rent growth. Occupancies are at an all-time high. That gives pricing power back to the landlords to push rents. We believe that the supply and demand equation is still very much intact in the multifamily space. Big portion of that is because the demand drivers are all still there. You have an aging population and you have population growth, which is causing household formations to average 1.02% growth since 2000. And that's still been relatively steady. And as that demand continues to grow, the supply side is very muted. Ever since the Great Recession in 2008, 2009, there has been a massive slowdown in supply creation, which has created a significant housing shortage in the market today. It's actually concerning. And the problem is you can't build new product at a price point that makes sense for the bulk of people who are looking to rent. It makes the existing stock and the thesis of going in, renovating units, and still achieving a premium rent, but still being at a $200 to $300 a month discount to the brand new product, a really attractive thesis and one that we continue to believe in. Another impact on the demand and supply equation is home prices are up 122% since 2012, and rents are up 67% in the same period. When single-family homes become unaffordable for more and more people, especially for millennials and younger generations that are notoriously terrible savers, the multifamily option becomes the only option, which continues to fuel the demand on that side of the equation as well. And lastly, we think that rent growth will be sticky and not drop. People have been up in arms, I guess, about the crazy rent growth in the past few years. But the reality is, if you look at a longer term picture, the average rent rate growth from 2000 to 2022 was about 3.2%, which is effectively what we're typically underwriting in our models, typically 2.5% to 3% market rent growth. That's proven out over a long period of time. Rents flattened and declined a little bit in 2008, 2009. And a lot of what's happened in that time since is just really smoothed out to that 3% annual growth rate. By contrast, construction costs have grown at a higher rate, 3.6%. And that is completely tied to the ability to create new supply. So we, in theory, should be able to grow rents over a long period of time at effectively the same rate or just a slight dip beneath the cost of construction. You can see here, we still think that there's room to grow rents in the market overall. So the punchline of all of this is, why buy real estate in all cycles? Well, that's kind of the question. And then more specifically, why buy now? One thing that, regardless of what we're going on in the broader economy, the interest rate environment, any kind of macroeconomic trend, is that humans are involved in managing and owning and operating real estate, and human error causes opportunities. We see all sorts of examples of this across the real estate world in deals that we look at. But a few different things that we're looking for specifically in deals that we're evaluating is poor management. That we have an example here. We bought West Grove Apartments. This is in our backyard in Wisconsin. They were charging $7 per month in other income total across the property, where normally in the market, anyone else is charging for utility bill backs, for parking, for application and admin fees, for pet fees. All of those things typically lead to $60 to $120 a month per unit in other income. They were charging $7. So that mismanagement opportunity, we were able to capitalize on that, grew NOI from $2 million to $3 million in just 3 years. This is a massive increase. A missed opportunity. Another deal that we looked at was called Crossroads. This was in Minneapolis. It was 98% occupied with rents at $730 a month in a really desirable location in Minneapolis. We were able to grow those rents to $1,200 a month, which still is relatively affordable. We invested significantly into the units, but we grew NOI from $2.5 million to $5.8 million in 3 years. That's a missed opportunity by the previous ownership that we were able to capture. The last opportunity is owners that are willing to sell off market. The competitive bidding process in a marketed deal is meaningful when you're an owner. And we've been able to buy a lot of our deals off market, both West Grove and Crossroads. Those deals I mentioned were acquired in an off market process. In Fund VI, we just did a $91 million equity recap. We were the only group looking at a $91 million deal in Florida. that is a really unique opportunity. We think we got a pretty significant discount on the fair market value and still have the chance to grow operating income through a rehab. Now, in spite of our significant belief that real estate is still investable, that multifamily is still investable, there are a few mitigating factors that we think are important. And this is where I'll really point to some of the strategic benefits of investing with MLG. First and foremost, diversification is critical. It's critical to get diversified within the totality of your investment portfolio across different asset classes, stocks, bonds, alternatives. But even within your real estate holdings, it's pivotal to be invested in a diversified way. Our fund invests in 30 to 35 properties that are diversified across different geographies and across different asset classes and across different risk profiles. Mixed within our fund, you'll see some value add deals where we're going to go in, we're going to invest into the units, we're achieving a premium rent that way. There's higher upside potential in value add deals oftentimes. However, there's more execution risk as you have to execute on that strategy. By contrast, you can buy a more, we call core plus deal, where you're buying a nice earning over asset in a great location, you buy at the right price, and you let the location and appreciation over time do the work. Typically a little bit lower return, less risk involved. You'll see a nice marriage of both of those within our funds. We think that's really important. And in general, the marriage of just diversification is critical because the reality is no sponsor can predict the future. Even the deal that's a pencils to an automatic home run in the underwriting stage, things happen in the market, things happen in the world that are unforeseen, and diversification helps to protect investors from that. The second mitigating factor that I think is critical is leverage. The biggest way that we're seeing people get in trouble in the real estate world right now are those who finance their deals with high leverage floating rate debt. The floating rate debt was great when it was total costs of 3%. But now that the short-term indexes have risen so dramatically, a lot of those borrowers are now facing interest rates in the 6.5% to 7% range, and they bought at a 3% cap rate. Even with significant NOI growth, you can't grow NOI fast enough to cover that level of interest rate increase. At MLG, we take that risk mostly off the table. In Fund VI, we've used exclusively long-term fixed rate debt. In the few instances in prior fund where we did use some floating rate debt, it was still low leverage and always had an interest rate cap in place, which put a ceiling on how high the debt interest rate was able to go. And it was because we believed we could grow the NOI in a short period of time and either sell or refinance thereafter. And then the last one, getting some long-term at a moderate leverage point, long-term on your financing is critical. You need to be able to hold through whatever the market throws at you. I'm expecting that we're going to see some challenges in the next, call it 2 to 3 years, from those who finance their deals with short-term floating rate debt. They maybe have a cap in place for the first 2 or 3 years. But as those caps burn off, they're not going to be able to refinance or sell at a number that makes sense for them. And it's either going to require significant capital to be brought to the deal, or they're going to have to sell at a discount. Using long-term debt gives you the opportunity to hold through cycles, gives you plenty of time to correct any issues at the property and execute on your business plan. Second to last one I put here is high quality real estate. There was a point in time in the market in 2021 where a 70s deal was trading at effectively the same cap rate as a brand new, nice property in a good location. We're not seeing that anymore. There really is a risk premium being added to older, less desirably located properties. And we want to be in the highest quality real estate available. We're seeing that tenants in the more workforce type demographic are struggling. I think it's just the beginning of the issues we're going to see there. But in higher quality, strong income, strong home value, proximate to the good jobs, proximate to the good schools, those types of tenants and those types of properties are able to deal with dips in the market without too much impact on their financial picture. And then the last one I'll say is invest with sponsors that know how to execute, not just sell with cap rate compression. The reality is everyone who invested in real estate, or pretty much everyone for the past 5-10 years, made a bunch of money because if they bought at a 6 cap in 2017, they sold at a 3 or a 4 cap in 2021. Well, those days are gone. You actually have to execute on your portfolio right now. And MLG has been around for 36 years. I would say these 4 things are probably the critical, if you remember nothing else from what I said, these are the differentiators for MLG in the marketplace right now. Getting diversified, long-term fixed rate, moderate debt, investing in high quality real estate, and a sponsor that's been around the block and not just selling with cap rate compression. Last thing I'm going to hit on here is just real estate versus U.S. Treasuries. I've seen a lot more people start to bring that up. It's attractive to invest at a 4% Treasury right now. And certainly there's a place for that in your portfolio, but we don't believe that that's actually pushing real estate out of the picture. We're going to do an after-tax return comparison of real estate versus U.S. Treasuries. And let's just assume for a second that you can invest in a Treasury at 4%. Let's say you're a highly taxed individual. You're going to pay a 40% effective tax rate, resulting in a net after-tax rate of return of 2.4%. In our funds, we target an 11 to 15% return. We've outperformed that historically, but let's just say for the sake of discussion, we produced a 12% rate of return. And because of the benefits on the tax side of investing in multifamily real estate, we generally estimate an after-tax effective rate, an effective tax rate of 25%, resulting in an after-tax rate of return about 9%. That's about a 6.5% differential on your after-tax rate of return. And that's money that's going into your pocket. Now, on the short term, that's maybe not a huge impact, but on a long-term example, that 6.5% when compounded over a period of time starts to make a really big difference overall. We look at the simple rule of 72 here. It would take you 30 years to double your money on an after-tax rate of return of 2.4% versus only 8 years if you're producing after-tax return of 9%. So what we're referring to this internally is the cost of liquidity, right? If you invested $250,000 over the course of 8 years, you would expect that to grow to about $300,000 at a 2.4% rate of return. On the same $250,000 invested at the 9%, it would grow to $500,000. So the question becomes, is that cost of liquidity worth it to you? The biggest drawback of investing in private real estate is that your money is locked up, whereas in a treasury, you have access to it. And so that's where the cost of liquidity comes into play. Now, the question becomes, can you still generate 12% returns in real estate? And I've kind of been hinting at this the entire presentation here, but we still believe that that's very possible. You have to be disciplined and consistent in your underwriting. You have to make believable and achievable assumptions. It's crazy when you look at the pro formas that are put together on these deals, how minor tweaks in the assumptions can make such a large impact on the forecasted return. So you have to be disciplined and not stretch when it's not necessary. We look at a lot of opportunities. One of the critical differentiators for MLG is that we source deals in two different ways. We're both a direct owner operator. We manage about 35,000 apartment units across the country, but we also are a joint venture equity provider for operators in other markets where we don't have boots on the ground. This dual fold sourcing strategy is critical for us. We review north of 100 deals per month with the intention of buying 1 to maybe 2 of those deals. But instead of stretching for every deal that we see in a given market, we're able to be very selective. We're able to choose from the best of the best. And that helps us to find the best opportunities for our investors. Interest rate volatility. We kind of hit on this, but the Fed has made it clear they have a 2% target inflation rate. At some point, we believe the 10-year Treasury will settle down between 2.25% to 3% when the Fed eventually gets to that 2% rate. The 10-year Treasury has historically been at an 80 to 150 basis point premium over the long-term inflation rate, and that's where we're kind of assuming that we can land at these numbers overall. It creates a really unique opportunity right now in the market. You can buy at a higher cap rate environment if rates just stop moving so quickly, or if they do come down over the course of the next 3 to 5 to 7 years. We think we're going to be able to buy in the high cap rate environment and sell when there's a lower cap rate environment overall in the marketplace. We are, like Jim said, we're actively raising for our Fund VI offering right now. We're targeting a $450 million raise, and we're targeting net returns to the investor of 11 to 15%. And we have a special deal with the white coat investors. Typically, we offer an 8% preferred return, a full return of capital, and a 70-30 split, 70% to the investor, 30% to MLG overall to target that 11 to 15%. For the white coat group, we've offered improved terms of 8% preferred return, full return to capital, and a 75-25 split, which would result in property level returns closer to 12 to 16% net to the investor. So we're already past that $5 million threshold required to achieve those terms, and would love to continue to add more of the white coat investor base to our Fund VI.
Yeah, awesome. That's good news to hear we've hit that threshold. So it's always nice to get a little bit better terms. Let's get into a little bit more of the details of Fund VI. You mentioned it's targeted a $400 million raise. How much money has been raised so far?
We are sitting at right around 155 to 160 million, and we're, I would say, just under a year into our raise so far.
And it's got, I think you said earlier, 19 more months before it closes. But if you hit 400 million, you'll close it early?
That's right. Yep, either or, whichever happens first.
Okay, and that, again, is going to be predominantly or entirely multifamily?
Predominantly multifamily. We actually already have some flex industrial in the fund that we're excited about, and we have a retail deal as well, as a premier location retail deal. We don't buy a ton of retail, but when we do, we buy, our general strategy is to buy a problem in a great location that we can fix and then sell. And that's the case in this instance. We bought a really well located piece of retail in the Twin Cities, and we'll look to sell that here in the near term.
Okay. And how much of the portfolio ends up being value add versus core plus?
We don't promise a specific allocation between the two. I would say Fund VI is definitely skewing more core plus right now, just like I said, a bias towards higher quality real estate and higher quality locations. We're doing less of really none of the 70s, 80s stuff, very, very little of that, and focus on 90s and newer, really functional real estate. And that just gives its way more towards a core plus type return profile and risk profile.
Okay. And you mentioned the preferred 8% return and the 75-25 split. Tell us about the other fees associated with investing with MLG.
Yeah, so the big one is we have a 1.25% asset management fee that's charged on your outstanding invested equity. That the 8% that we owe you is net of that. So really, to get you 8%, we have to produce a 9.25%. And that's, I think, actually pretty low relative to what we see a lot of other groups doing in the marketplace. The other big fee that's relevant is we have a 1% acquisition fee that's taken on each acquisition. That's a one-time fee, is 1% of the purchase price. And those are the two big ones. There's some other ones that are at play. If we self-manage, we pay our affiliate management company a market rate management fee. If we have a third party or a partner do that, we pay them that fee. It's kind of cost of doing business in multifamily. Similar with construction management. If we do a project, there's usually a 5 to 7.5% fee on that. Again, either to us or to the partner that's executing on that work.
Okay. All right, let's talk about taxes for a minute. The MLG funds generally send you a K-1 each year, and that passes through depreciation to the investors, obviously. But you also have another option. Tell us about that other option with the MLG funds.
We do, yeah. And that's another differentiator for us. We have two different vehicles by which you can enter Fund VI. You're invested in all of the same properties. You're expecting the same pre-tax returns. The difference really lies in how the tax or the income that you realize is characterized from a tax perspective. The first one, like Jim just mentioned, is a traditional LLC structure. It's all a pass-through, massive depreciation expense being passed through to investors. We have a unique secondary structure that we call our dividend fund. If you can picture it, we own the properties, cash flows from the properties up into a non-traded private REIT vehicle, and then from there to investors. All that does is it reclassifies the income that you realize from passive rental income to dividend income, which has two primary benefits. One, if you're looking to invest through a retirement account vehicle, you can do so without triggering unrelated business taxable income, or UBIT, for those familiar with the issue. In layman's terms, it avoids any additional taxes being levied against your retirement account income. That's a really powerful benefit of this structure, very well set up for 401k and IRA investments. But also, people will just put after-tax dollars, cash into the dividend fund to avoid the multi-state filing potential that exists on the main fund side. The trade-off there is those losses that are produced from massive depreciation at the properties are trapped at the REIT entity level. Even if you invest cash into the dividend fund, you still have a very tax-efficient investment as it specifically relates to your investment with MLG, but what you lose is a passive loss that flows through to you that can be used to offset other passive income from other investments that you may have. So smaller dollar investors generally tend to be a better fit for the dividend fund. If you're thinking of the longer term, larger investment, then the private fund or the other side of it might be a better fit for you.
I suspect as a REIT, the dividend fund would also qualify for the 199A deduction with its income.
That's correct. Now, the goal in the dividend fund, similar to the private fund, is to produce minimal, if any, ordinary income. The goal would be that the REIT is using those losses to offset any distributions at the REIT level, and then we're only paying or realizing any taxable income when we sell, and it's capital gain taxes that we would owe. But you're right. To the extent that there is any ordinary dividend income produced, it would be eligible for that qualified business dividend deduction.
Now, if you're in the traditional LLC that sends out the K1, how many states does MLG 6 invest in now, and do you expect that to increase?
We are in 7 states as of now, I believe, 3 of which are Texas, Florida, and Tennessee, which don't have state income tax. I would expect we'd be in 12 to 14 states when it's all said and done, plus or minus. So you're probably looking at 8 to 10 different states you'd need to potentially file taxes in. For those that have significant passive ordinary income, the savings that can be produced by using our losses to offset and defer that income can be very, very powerful. But it's not for everybody. There definitely will be an impact to your tax prep cost. So it's worth consulting your CPA, both to see what it will cost you and also how those losses could potentially benefit you.
Will MLG file composite returns in the states that allow those?
We do not. There's some limitations in the carry forward ability and composite returns, and with investors coming in at such different times throughout the fund, it just ends up not actually being as much of a net benefit as it might seem like. So we do not.
Okay. And who would you describe as the ideal investor for MLG?
Well, like you mentioned before, you have to be an accredited investor to invest in our funds. I would say you also, just given the intended life cycle of these funds being 10 to 12 years, you probably need to be someone with a little bit longer horizon in your overall investment. Within our return structure, we try and return your capital in 6 to 8 years. The fund isn't fully realized, or the return isn't fully realized until that 10 to 12 year life cycle. So you want to have a little bit longer term. And then I would also say we're definitely interested in building long-term relationships with investors to exist for many years to come. And we hope that the plan is that this is a part of your investment portfolio and not just a one-time thing. So as you continue to grow your wealth, as you continue to have more income, we hope that we'll earn continued reinvestment and trust from you over time.
And what's the minimum investment for Fund 6?
If you are investing cash, the minimum is $50,000, and that's either in the private fund or the dividend fund. But if you're investing through a retirement account, the minimum is $100,000.
Okay. And one of the big benefits of MLG, one of the big differentiators, especially as we compare you to even our other sponsors and partners, is you've been around for 36 years. That's forever in the private real estate world. What do you see as the advantages of having been around that long?
Well, I mean, it shows that you've been able to navigate through different cycles in the market. Our principals, which have all been here since I think the most recent principal edition was in 2006, but prior to that, it was all in the late 80s and early 90s. They went through the 2000 to 2004 recession. They went through 08, 09. They've seen really everything under the sun related to commercial real estate, and they know how to navigate through those different things. And their experiences help us avoid a lot of foot faults that younger, less experienced sponsors may not have. And I wasn't around at the beginning of the company's history, but even today, I'll bring deals that have a specific location or a specific quality to the investment committee, and they have insight that avoids us or helps us avoid making those mistakes. Over the course of 36 years, this is a fun stat I like to share. For every dollar that we've invested, on average, we've turned it into $2.62 on an average hold of just under 5 years. That's really good math for that long of a time over, I think, 95 full cycle deals in that time. We're really proud of that, and we expect that we're going to continue to be able to produce really attractive results.
One of the nice things about having kind of a long-term fund that holds onto your money for 5 or 7 or 10 or 12 years is that it increases your tax efficiency. The downside, of course, is your liquidity isn't so good. Tell us about liquidity options for Fund 6, before the fund wraps everything up. What options do investors have to get money out?
You do not have any built-in liquidity mechanism in our funds. We do start returning capital in staggered chunks, probably in year 3 or 4 of the fund and continuing through year 6 to 8. So that's kind of the window where you'll start to see some return to your capital. But this should be money that you're going into thinking reasonably not going to need this for 6 to 8 years' time. Obviously, life happens. We've worked with people on a one-off basis, but go in thinking this money is locked up. And that's, that's why it's not meant to be your entire investment portfolio. It should be a portion. It should be a longer-term bucket of money in your mind.
But you do get income periodically from it. Quarterly distributions, I believe.
Quarterly distributions. We continue distributions even through COVID. Since I've been here, we've never not made quarterly distributions.
Awesome. Well, I think I've about run out of questions for you. I appreciate your time and telling us about, MLG, about Fund VI in particular. Those who want to get more information about MLG and this investment opportunity can go to whitecoatinvestor.com/MLG. And Nathan, we appreciate your time today and appreciate those who have tuned in to listen to this webinar.
Yeah, thank you, Jim. And thanks to all that listen. Always love catching up with you and love sharing about what we're doing here at MLG. If anyone has any questions, my contact information is available on our website as well as I think also on the landing page. Please reach out, schedule a call directly. Happy to connect with each of you individually.
Thank you so much.
Thanks, Jim.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.